They took their best shot. They waited for the cover of darkness. They waited until the liquidity was thin and the order books were empty. Then they pulled the trigger. On Friday night, the powers that control the paper-silver market executed a coordinated attack. They raised the margin requirements. They flooded the order book with paper short positions. They painted the tape red going into the weekend. For 48 hours, they wanted you to believe that the silver bull run was over. They wanted you to believe that the crash had finally arrived. But when the sun rose over London this morning, the smoke cleared and the bull was still standing. We have just witnessed one of the most significant market signals of the last decade. It was not a press conference. It was not a Federal Reserve announcement. It was the price action itself. The market did not just recover, it exploded. The massive gap up we're seeing today, erasing the losses of the previous sell-off in a single session, is not normal market behavior. It is a scream. It is the sound of a bear trap snapping shut on the fingers of the biggest banks in the world. It is the sound of the short sellers realizing that there is no physical metal left to back their paper bets. And it is the confirmation that the buy-the-dip mentality has shifted. It has moved from retail traders on Reddit to sovereign nations and industrial giants. If you panicked and sold during the drop, I have bad news for you. You were the liquidity they needed. You were the fuel for this rocket. But if you held, if you understood the game, you were watching vindication in real time. In this deep dive market analysis, we are not going to look at predictions. We are going to look at the crime scene. We are going to dissect exactly how the banks tried to kill the price and why, for the first time in 40 years, their weapon jammed. We are going to explain the mechanics of the V-shaped recovery and why this specific pattern signals that the low is in. The paper price tried to lie to you. The physical market just told the truth. This is the anatomy of a failed crash. To understand the violence of this rally, you have to understand the trap that preceded it. Because in financial markets, nothing moves in a straight line. Bull markets are designed to buck you off. They are designed to cause maximum pain to the maximum number of people. What we saw recently, the sharp, sudden drop that terrified everyone, was a classic textbook bear trap. Here's how the mechanism works. The banks know where the stop-loss orders are. They know that thousands of retail traders set their automatic sell orders just below key psychological levels like $60 or $62. To get liquidity, the banks have to trigger those orders, so they use a catalyst like a margin hike or a scary news headline to push the price down just enough to hit those triggers. Snap, the stops fire. The retail traders sell automatically. The price creates a scary red candle. This convinces the bears that the trend is broken. They pile in. They short the market. They bet the house that silver is going back to $50. But then the trap closes because the banks are not selling to exit, they are buying. They push the price down to generate the selling volume, and then they absorb it all. They buy the contracts from the panicked retail traders. They buy the contracts from the overconfident bears. And once they have filled their bags, they step away. Without the artificial selling pressure, the natural demand takes over, like a coiled spring. We need to talk about the margin nuke, the exchange raising capital requirements to force selling. Historically, this is the ultimate weapon. In 2011, it worked perfectly. They raised margins and silver collapsed 30% in days. It scared the speculators away for a decade. They tried it again this week. This time, they raised the cost of doing business. They tried to make it too expensive for you to hold your position. And initially, it looked like it worked. The price dipped. But then, something unprecedented happened. The market absorbed the blow. Why did it fail this time? Because the composition of the market has changed fundamentally. In 2011, the market was dominated by weak hands, speculators using 20 times leverage who could not afford the margin call. When the call came, they had to sell. Today, the market is dominated by strong hands, industrial users, family offices, and sovereign wealth funds. These entities are not gambling. They are hedging supply chains. They are protecting wealth. They have deep pockets. When the exchange said, "You need to put up more cash," these buyers did not sell. They wired the cash. This is a disastrous signal for the manipulators. It means their pain threshold calculation is wrong. They thought a 50% margin hike would break the back of the bull. Instead, it just annoyed the bull. When a market ignores bad news or regulatory attacks, it is a sign of extreme underlying strength. It means the buyers are not price sensitive, they are volume sensitive. They care more about getting the physical silver than what the margin requirement is. The failure of the margin nuke to sustain a crash is the all-clear signal for the next leg higher. Let us talk about what this does to the psychology of the market. Markets run on two engines, greed and fear. But there's a third, more powerful engine called regret. The V-shaped recovery, where the price crashes and immediately recovers to new highs, is a regret machine. Think about the guy who sold on Friday. He was scared. He saw the red numbers. He thought he was being smart. He thought, "I'll sell now and buy back lower at $55. He went to bed feeling safe. Then he woke up on Monday and silver is higher than where he sold it. He didn't save money, he lost his position. Now he has to make a choice, admit he was wrong and buy back in at a higher price, or wait and pray for another crash. Most people wait, they refuse to buy back higher. They watch the price go to $60, $68, $70. The regret turns into fear of missing out. Eventually, they panic and buy back in at the top. This is how bubbles are formed. The shakeout removes the weak believers early. It leaves the train lighter so it can travel faster. And it forces the skeptics to chase the price. This recent volatility was a cleansing event. It washed out the leverage. It reset the sentiment. It turned overbought conditions into neutral conditions without actually breaking the trend. If you are just joining us, let us recap the crime scene. Friday was the smash. Sunday night was the gap up. But the real story, the story that will define the next 6 months of this bull market, happened just a few hours ago in London. For 40 years, London has been the suppression capital of the precious metals world. The London Bullion Market Association is where the big banks trade. It is where the fix is set. Historically, when the price got too high, London would flood the market with supply. They were the seller of last resort. Whenever New York panic bought, London would calmly sell and cool the market down. But today, London did not sell. London panic bought. When the market opened in the United Kingdom, we saw massive, aggressive big orders hitting the tape. This is a change of character for the market. It is like watching a firefighter start pouring gasoline on the fire instead of water. Why did they switch sides? Why are the bullion banks suddenly chasing the price up instead of smashing it down? It is not because they became silver bugs. Banks do not have ideology. They have liabilities. They switched sides because of one terrifying metric that the public rarely sees, called the float. We talk about inventory all the time, but inventory and float are not the same thing. Inventory is the metal in the vault. Float is the metal available for sale. Let us clarify a misconception. Bearish analysts love to point to the vault data and say, "Look, there are still 800 million ounces in the London vaults. There is no shortage." They are technically right about the number, but they are completely wrong about the meaning. That 800 million ounces is an iceberg. The vast majority of that metal, probably 85% to 90%, is spoken for. It is owned by exchange-traded funds. It is owned by sovereign wealth funds. It is owned by family offices who vaulted it in 2010 and threw away the key. That metal is not for sale, it is strategic inventory. It sits there collecting dust. It does not move at $30, and it will not move at $60. The only metal that matters to the price is the float. This is the unallocated metal, the metal that sits in the dealer pot, the metal that can be leased to a refinery, sold to Apple, or delivered to the COMEX. Historically, the float was massive, hundreds of millions of ounces. But over the last 3 years, as India bought 2,000 tons here and 1,000 tons there, they did not buy the exchange-traded fund metal, they bought the float. They drained the dealer pot. So today, when we look at London, the iceberg is still there, but the tip, the float, is gone. It is melted. This creates a liquidity crisis. If Samsung needs 1 million ounces today, they cannot buy the strategic metal. They have to buy the float, but the float is empty. To understand why the banks are buying, you have to understand the leasing market. This is the dark heart of the silver trade. Bullion banks do not just sit on silver, they lease it out. They lend silver to industrial users, like refineries or electronics makers. The user takes the silver, uses it, and promises to return it later, plus interest. This system allows the industry to function without buying the metal outright. It also allows the banks to make money on their stack. And crucially, it creates virtual supply. The same ounce of silver can be leased out and returned and leased again. It creates the illusion of liquidity. But here's the problem. What happens if the industrial user consumes the silver? What if they turn it into a solar panel or a missile? They cannot return the metal. They have to go into the open market, buy a new bar, and give that to the bank to close the lease. For years, this was easy because silver was cheap. But now refineries are halted. The float is gone. The industrial users are calling the banks and saying, "We cannot return the metal. We cannot find any to buy." This causes the silver lease rates to spike. When lease rates spike, it is the market screaming shortage. It means banks are desperate to get their physical metal back. Today, we're seeing signs that the leasing machine has jammed. The banks realize that the metal they leased out is never coming back. We have established that the physical market is broken, but now we have to look at the technicals, because even in a supply shortage, price does not go up in a straight line. It moves from battle to battle. And right now, the entire silver market is staring at one specific number, $65. We are currently trading around $63.35. We've recovered the Friday losses, but $65 is different. $65 is not just a resistance level, it is the kill zone for the short sellers. Why is $65 so important? Is it magic? No, it is liability. In the derivatives market, speculators buy call options, and these are bets that the price will go up. Right now, there is a massive concentration of open interest at the $65 strike price for the December and January contracts. Millions of ounces are betting on a break above $65. Here's the problem for the banks who sold those options. If silver stays below $65, those options expire worthless. The banks keep the premium and they win. But if silver crosses $65, the banks are on the hook to deliver millions of ounces at a discount. This creates a phenomenon called delta hedging. As the price gets closer to $65, the market makers get nervous. Their computer algorithms force them to buy silver futures to hedge their risk. If they sold a call option on 5,000 ounces, they might have to buy 2,000 ounces of futures just to be safe. But here's the catch. Their buying pushes the price higher, which makes them even more nervous. So they have to buy more futures, which pushes the price even higher. This is called a gamma squeeze. It's a self-reinforcing feedback loop. It's what happened to GameStop, it's what happened to Tesla, and it is waiting to happen to silver. If we break $65 with volume, the market makers flip from being neutral to being forced buyers. They will have to chase the price to $66, $67, $68 just to cover their exposure. This is the vacuum effect. Above $65, the air is thin. The resistance disappears because the defenders become the buyers. This is why you'll see massive volatility around $64.80 or $64.90. The banks will throw everything they have at that level to prevent the dam from breaking. They will sell paper, they will trigger stops. But if the physical demand from London and Asia keeps pushing, the dam will burst. There is a final layer to this panic known as the unallocated account run. Many wealthy investors and institutions hold silver in unallocated accounts in London. This means you do not own specific bars, you own a claim on a pool of silver held by the bank. It's like depositing cash. You don't own the specific bills, you own a claim on the bank's liquidity. For decades, banks ran a fractional reserve silver system. They might hold 100 ounces of physical silver for every 500 ounces of claims they sold. They assumed that not everyone would ask for their metal at once, but the recent volatility scared the big money. Family offices are starting to say, "I do not trust the unallocated account anymore. I want to convert to allocated. I want my specific bars. I want to see the serial numbers. I want them moved to a private vault." This is a silent bank run on silver. When a client converts from unallocated to allocated, the bank has to take 1,000 ounces out of the general pool and put a name tag on it. That silver is now removed from the float. If the bank was running fractional holding, only 20% real metal, and 30% of clients demand allocation, the bank is insolvent. They have to rush to the market and buy the missing bars. This is exactly what fueled the rally this morning. It's billionaires sending legal notices to bullion banks demanding physical segregation of assets, and the banks are buying the dip to fulfill these demands. Let us talk about the force that will drive the market for the rest of the month. We are currently in the second half of December. This is a critical time for Wall Street. It is the end of the fiscal year. Hedge funds and mutual funds have to send their annual reports to their clients. These reports list the assets they hold. Here is the psychology of a fund manager. If silver is the asset of the year, up massively driven by tech shortages, and the fund manager holds zero silver, he looks incompetent. His clients will ask, "Why did we not own the best performing asset?" He risks getting fired. So, what did they do in the last 2 weeks of December? They engage in a practice called window dressing. They buy the winners at any price just so they can show it on their balance sheet on December 31st. They want to be able to say, "Look, we own silver. We were part of the rally." This creates an artificial but powerful tailwind into year-end. Funds that ignored silver at $30, $40, and $50 are now forced to buy at $63 just to save face. They are price insensitive. They just need the position. This institutional fear of missing out is what drives prices parabolic in late December. We saw it with tech stocks in the past. Now we are seeing it with commodities. The Samsung news gave them the cover story. The price action gives them the urgency. So if you see silver rallying on low volume during the holidays, do not be surprised. It is the smart money trying to look smart after being dumb all year. And you, the individual investor who bought at $25 or $30, you are the one holding the inventory they desperately need. Markets are cruel mechanisms. They are designed to transfer wealth from the many to the few. They usually move in the direction of the max pain trade. Right now, ask yourself what outcome causes the most pain to the most people. Let us look at the scenarios. Scenario A is that silver crashes back to $50. Who does this hurt? It hurts the silver bugs. But silver bugs are used to pain. We have held through decades of suppression. We do not sell on dips, we buy more. So a crash does not generate liquidity, it just locks up supply tighter. Now look at scenario B, where silver rips to $75. Who does this hurt? Number 1, it hurts the banks, who are short hundreds of millions of ounces. Number 2, it hurts the industry, who needs silver for solar and batteries. Number 3, it hurts the public, who are sitting in cash, watching inflation eat their savings. Number 4, it hurts the pros, the hedge funds, who are underweight commodities. Scenario B causes maximum pain to the establishment. It blows up bank balance sheets. It forces industry to panic. It humiliates the professional money managers. Therefore, according to the laws of market sadism, scenario B is the most likely outcome. The market wants to squeeze the shorts. The market wants to force the uninvested capital to chase the highs. The bear trap on Friday was the final attempt to get you off the train before it left the station. If you were still on board, you aligned with the pain trade. You were the one inflicting the pain, not receiving it. Let us end with the macro perspective. Why does this move matter? Because it confirms the wealth transfer. For 40 years, wealth flowed from real to financial. It flowed from factories to derivatives. It flowed from gold to treasuries. It flowed from silver to tech stocks. That tide has turned. The Samsung battery is not just a gadget. It is proof that the physical world is reclaiming its value. You cannot print a battery. You cannot print a solar panel. You have to dig it. When the price of silver gaps up while the bond market wobbles, it is the market voting for reality. It is the market saying that an ounce of silver, which requires labor, energy, and geology to produce, is worth infinitely more than a digital entry on a Federal Reserve computer. You are living through a historic pivot point. Your grandchildren will ask you what you did during the resource crisis of the 2020s. Did you hold paper or did you hold metal? Friday was a test of your faith in that thesis. If you held, you passed. Monday is your reward. The day the bear trap failed. The day London panicked. The day the path to $65 opened up. I want to leave you with one final warning. Just because we are winning does not mean the war is over. The volatility will get worse. $2 swings will become $5 swings. $5 swings will become $10 swings. You need to harden your stomach. If you are over-leveraged, you will get washed out. If you are watching the ticker every second, you will get stressed out. The strategy remains simple. Accumulate physical. Secure unhedged miners. Sit tight. The market is doing the work for us. The shortage is doing the work for us. Samsung and China are doing the work for us. Let the smart money chase the price. We are already seated. Congratulations to the diamond hands. The bear trap has snapped. The rocket has cleared the tower. Now we just have to hold on.